Waiting for Warsh. Traders avoid big bets ahead of the Fed chairman's first Jackson Hole speech, with Fed officials divided on the rate outlook. Oil flows tick up through the Strait of Hormuz as the top US commander for the Middle East says American forces have cleared Iranian mines from the key waterway. Plus, France's debt difficulties dominate the first presidential debate as data out today shows the country's economy only narrowly avoided recession in the first half. Well, a very good morning. Welcome to The Pulse. Happy Friday. This is the picture in markets as they hold their breath for Kevin Warsh's Jackson Hole debut. S&P even is treading water. Crickets in the bond space. Oil lower. We're trading at $89 a barrel now as more oil gets through the Strait. And euro-dollar also pretty steady after the latest European data. We'll dive into that later, but first let's take a look at what's happening in the European equity picture an hour into the cash trade. Let's bring on our map. Broadly, the stock 600 is up 0.4%, set for its fifth straight monthly gain today. The CAC 40 in Paris is the outperformer this morning after its worst day in 7 weeks. The FTSE 100, the laggard, though, not helped by those lower oil prices, weighing on the energy majors. So those are your markets. It's a quiet August Friday as we hold our breath for Warsh. Let's get started.
Newsmakers and market movers. This is The Pulse.
Good morning and welcome to The Pulse. I'm Lizzie Burden in London. Happy Friday. Well, investors are waiting to hear from Fed Chairman Kevin Warsh at the Fed's Jackson Hole Symposium later today. Ahead of that speech, Chicago Fed President Austan Goolsbee expressed a cautious stance.
I need evidence that inflation, that this inflation shock is not going to be persistent. And I'm okay with waiting as we're getting that. But if the evidence starts coming back, especially on services, that it's high, it's going the wrong way, we're not making progress, then I'm going to be nervous.
Well, as we wait for Warsh, let's speak to Paul Hollingsworth, Head of Developed Markets Economics at BNP Paribas Markets 360. Good to see you, Paul. Happy Friday to you as well. How much clarity does the market need from Kevin Warsh at Jackson Hole to reassure it? Like, if all he does today is talk about the task forces, as many are expecting, how disappointed do you think the market will be?
So we aren't looking for Kevin Warsh to give much signal, certainly on the September meeting. Today, he's shown a sort of distaste for forward guidance. We think he would probably prefer to wait for the outcome of those task forces before making any significant policy change. And on top of that, some of the recent data has perhaps taken a little bit of the pressure off in terms of the urgency to act. But taking a step back, the Fed has not achieved its inflation target for more than 5 years. We think underlying price pressures are building. We have an economy that is running quite hot at the moment. So we think the Fed will ultimately have to back up tough talk with actual action. And as a result of that, we are looking for the Fed to hike interest rates 3 times, but starting in December rather than September.
OK, really interesting, because I do just want to play you a bit of what Rajaa has had to say on the level of rates. He, of course, is the former governor of the Reserve Bank of India. He now sits on one of those very task forces that I mentioned. Let's just take a listen.
I would be more hawkish than where the Fed is right now. I certainly would have been averse to cutting rates last year, and I certainly would be at a higher level than now. I do think that financial conditions are not restrictive at this point.
So in a sense, you agree with him because you say that the Fed isn't hawkish enough right now.
Absolutely. I couldn't have put it better myself. I mean, the predication of our 3 hikes, if you like, is that we think the 3 cuts that were delivered last year were not necessary. They were risk management cuts due to concerns about the labour market, which proved unfounded. So we think the Fed can remove those 3 cuts without having a significant dampening effect on economic activity. We think policy is slightly accommodative at the moment, so there is space to move it higher to a more appropriate level for the strength of the economy. And when I take a step back and look at inflation dynamics, what you have is inflation that is responding to a number of shocks. We have a couple of supply shocks. tariffs being one of them, higher energy prices being another. We have a demand shock, which is, of course, the AI build-out, which is putting a lot of upward pressure on demand in the global economy and in particular in the US. And then we have a labour market that, although jobs growth is not especially strong, the labour market is still quite tight because we have some weakness on the supply side as well. And so we think that is an environment that creates sticky price pressures and therefore something that the Fed does need to respond to.
OK, but imagining a world where that is not the guidance that Kevin Warsh gives today, do you think that essentially he can go nowhere near talking about the balance sheet, given the situation that we've seen when it comes to yields, off the back of what the Treasury Secretary has done in the bond market, talking about this bond buying programme?
Now, clearly, the balance sheet is something that is quite central to Kevin Warsh's ideas about what he wants to change with the Fed. Of course, what we've seen is an increase in long-term yields, I think, driven by a number of factors. I think first, of course, has been the strong economy. That is something that is contributing to this increase in yields. Second is concerns about the Fed's credibility. So that is something that, of course, the market will perhaps want to see what messaging the Fed gives on inflation today. Third is fiscal concern, and that's something that's not in the gift of Kevin Warsh. And finally, we have the increase in hyperscaler issuance. That's contributed to concerns about long-end supply more generally. So, all of these things, again, some of that is not really within the gift of Kevin Warsh to comment on. Perhaps he will say something on the balance sheet, but probably within the context of an update on many of the different task forces that are underway at the Fed.
But are you worried about the Fed and the Treasury pulling in opposite directions at the moment? Let's say that this intervention into the bond market weakens the dollar by lifting import prices. Does that then risk fueling inflation and putting the Treasury, as I say, at loggerheads with the Fed?
There certainly does appear to be a little bit of an inconsistency, if you like. Kevin Warsh has effectively said he doesn't want to give forward guidance because he wants to get a clean read from the markets on what it thinks about the economy. But if we have, on the other hand, the Treasury making some policies to try and affect long-term bond yields, then that may distort the signal. At the same time, Warsh is saying he wants to shrink the balance sheet over the medium term, which may allow him to cut interest rates to sort of offset that in the short term. Again, that seems a little bit inconsistent between the two. So I agree. I think there is a tension there in the framework.
All right, Paul, I hope you'll stay with us. We'll come back to you in just a moment. But that is Paul Hollingsworth there of BNP Paribas Markets 360. Now, I want to turn our attention to France because managing France's soaring debt was a key focus of the nation's first presidential election debate last night. The 7 contenders presented arguments from slashing welfare to simply cancelling some of it. So let's get some analysis now. We can bring in Bloomberg Economics senior geoeconomic analyst Antonio Barroso. Antonio, good morning to you. So who are emerging as the front-runners, according to the opinion polls now?
Good morning. So the first thing to keep in mind is that it's very early in the presidential race. So around a quarter to even a third of voters in the last election decided their vote in the week running up to election day. So a lot can change still. Now, that being said, there is a clear front-runner, Marine Le Pen, the far-right candidate, who is mastering around 32% of support in the opinion polls. And then far behind, you have a pack of candidates. One of the things to retain here is that the center is very divided, with 3, potentially 4 candidates above 10%, which increases the chances that actually a candidate from the far left side of the spectrum, Jean-Luc Mélenchon, might make the runoff. So all of this to say that the prospects of a runoff between 2 radical candidates is becoming quite material.
But what's going wrong for the centre? Why is it so divided?
Well, because you had a very strong figure that used to unify the center. That was current President Emmanuel Macron. He's not running this time. He cannot run. Yeah. So what you have is basically a very fragmented centrist field. And unless these figures can coalesce around a single candidate, particularly on the center-right space, there is the risk basically that Mélenchon might actually go ahead of all of them and that he might make the runoff against Le Pen.
But of course, what the bond market wants to know is how France's debt is going to be managed. Did you hear any credible ideas on a plan for that?
So it was very interesting because the candidates predictably fell along ideological lines. That means that left-wing candidates proposed tax increases and right-wing candidates proposed to cut spending. Now, there were very few real numbers, lack of clarity on how they will do that. The only one that came prepared with numbers arguably was former Prime Minister Gabriel Attal. But overall, not a lot of real numbers. And on top of that, you had proposals such as that by Marine Le Pen to actually bring down retirement age to 60 for certain categories of workers. And then you have colorful ideas such as that of Jean-Luc Mélenchon for the Central Bank of France to cancel interest payments on the sovereign debt it holds. So overall, I think the main takeaway is that there's still a lot of lack of clarity, but also that if Marine Le Pen or Jean-Luc Mélenchon were to win the election, it is very unlikely they will make a strong effort to reduce France's public deficit and public debt.
OK, Antonio, thank you very much. That's Antonio Barroso from Bloomberg Economics. And let's bring back in now Paul Hollingsworth from BNP Paribas Markets 360. Paul, just off the back of that, how much do you see the oats-bundt spread widening as we get towards that presidential election then?
Yeah, so I think for me, there's kind of three takeaways that we saw from yesterday. The first is that this is a clear sign that the debate has kicked off in earnest. And certainly investor interest in French politics and the French budget has picked up a lot over the past few weeks. The second takeaway for me, and has already been highlighted, was that divide between the left and the right in terms of economic policies. But more than that, while there were no surprises yesterday, there was a lot of question marks about the fiscal arithmetic behind some of these plans, particularly those parties that do want to roll back the pension reform, which fundamentally is required for a sustainable debt to GDP path in the medium term. And then the final takeaway for me is really that fact that you now see a greater probability in some of the polls that the second round becomes a runoff between Mélenchon and Le Pen. So in that context, I think it's fair to say that we think that OATs can underperform. They can continue to underperform. But a lot is already in the price. So your political uncertainty is not just coming to the surface now. It's something that's been bubbling away for a long time. So there is quite a lot already priced in. But certainly in the near term, we think that OATs can continue to underperform.
OK, so 85 basis points is where we are on the spread at the moment on the 10-year. We also, of course, had new data out this morning from Spain and France. Spain releasing inflation surging past 4%. France publishing inflation accelerating to the highest level since May on the energy costs. And so both strengthening and strengthening the case for September rate hike from the ECB. But, of course, that's already priced in. We had the ECB minutes last night. And I mean, if the hawks already wanted to raise rates in July, Paul, if we think beyond September, when does the follow-up come?
Yeah, so if we look at the account of the July meeting that was published yesterday, as you say, there was this debate about the policy stance. Some of the hawks already potentially would have supported a hike at the July meeting. September for us feels all but nailed on now. I think it would take a big surprise for them not to go. The debate, I think, is then going to shift towards whether restrictive policy is required or not. Now, keep in mind that the upper end of the ECB's estimate of the so-called neutral interest rate is 250. So after the September meeting, we reached that level. And I think the debate will be between those that say the ECB is still fundamentally dealing with a supply shock, and so it shouldn't go too far when it comes to tightening policy, and those that say, well, actually, there's a lot of resilience in the economy. Isabel Schnabel's comments from earlier this week, for example, pointed to the strength of the economy, suggesting that risks may now be skewed to the upside. So certainly those in that camp would probably argue that maybe mildly restrictive policy would be warranted. Now, in terms of the timing, I think it's very uncertain. The path beyond September, just in general, looks quite uncertain. But that's probably a debate that would more or less take place in December when the ECB updates its projections once again. And we think one of the key things to watch over the coming months will be, firstly, the broadening of the shock. So in particular to oil products and natural gas prices. The latter is particularly important for Europe. And second, it's what's happening in terms of wage dynamics. We've seen some upward pressure in indicators such as the Indeed wage tracker. That is a leading indicator, so something the ECB will be paying close attention to. But in its own forward-looking wage tracker and some of the other data, wage pressures remain muted. So we think that is going to be a key indicator to keep an eye on over the coming months to see whether or not actually restrictive policy is required to tame inflation.
OK, really interesting. Paul, I just finally want to get your view on the UK, because we've had a report from the FT this morning that the Chancellor, John Healey, is going to shelve his own defence spending target, i.e. 3% of GDP by 2030. And we, of course, remember that he resigned over what he said was inadequate funding for defence when he was Defence Secretary. If this is true, even if perhaps it's not the best news for national security, is it something that the bond market should embrace?
I think the markets have been going through this period of transition and political uncertainty in the UK, and are really looking ahead to the budget and this kind of moment of clarity that could come. I think the markets would like to see evidence of credible policy package. Of course, concerns that there will be a shift to the left with a sort of big borrowing impulse. Our own view has been that Burnham's comments that he would stick to the fiscal rules are ones that he'll follow through on. In other words, this would be a sort of fiscally responsible set of policy choices without a big borrowing impulse. And so I think that very much goes in that direction. I think more broadly, looking at how the markets are thinking about the UK, there has been a lot of pessimism about the prospects for the UK economy. We think too much pessimism, in particular around the labour market, which has shown some signs of stabilisation. The data in general has been surprising to the upside. So as we're seeing with the global economy, there is some resilience there. There is some momentum there. And I think that is also positive. I'd say the final lingering uncertainty is about the Bank of England and its reaction function to this energy shock. We think that the BOE will have to hike once as a sort of insurance hike, if you like, to try and protect against some of those second round effects. But the Bank of England has shown some reluctance to increase interest rates, and at the moment is treating this as a sort of temporary supply shock. But the markets are pricing in hikes and effectively rates staying elevated for quite some time. If, which is our view, the Bank of England next year begins that downward path for interest rates again to a more neutral level, then that's also something that would be supportive for gilts.
OK, Paul, thank you very much. That's Paul Hollingsworth, Head of Developed Markets Economics over at BNP Paribas Markets 360. Have a great weekend. Well, coming up on The Pulse, could Venezuela exit OPEC and enter into an oil field leasing deal with the US? We'll get you the details next. This is Bloomberg. Goldman Sachs reporting that oil exports from the Persian Gulf have recovered to around 2/3 of pre-war levels. This comes as the US Central Command says it's successfully cleared sea mines in the Strait of Hormuz and that shipping lanes in the area are open. Let's get more now with Bloomberg's EMEA News Director, Will Kennedy. Will, I want to start off with a lively debate that seems to be happening among Bloomberg viewers at the moment. And that is really what matters more for the oil price, because it's kind of been capped below $90 a barrel. Is that more because you've got oil flows still going through the Strait, or is it because traders are watching the diplomatic developments?
It's going to be both, but I think in recent days the more material development has been this relatively strong flow of oil through Hormuz that we reported yesterday, that Goldman Sachs wrote about today. If we go back to mid-July, just after the MOU collapsed, flows fell to probably about 4 million barrels a day. We're now back up to, say, 8 million barrels a day. That's a big change for the market. And some of the fears about this blockade, Hormuz closure, having a really bad impact on supply and demand in the global market have not come to pass, because 8 million barrels a day or something like that is getting out. Of course, if diplomatic efforts are revived, if we do get a broader agreement about Hormuz and flows are able to rise further and stay open, that's a huge change for the market. So people are going to stay focused. But facts on the ground, supply and demand balances, this is what matters in the market right now. And
maybe the answer is simple to this, but I'm looking at natural gas prices up today, but oil prices down. How can that be?
Because we're getting oil out of the Persian Gulf, but we're not getting natural gas. So there's the logistics of shuttle tankers, this quite well worked out system where tankers are loaded in Saudi Arabia, in the UAE, they turn off their transponders, their signal, they come out of the Strait of Hormuz and they load that oil into tankers who then deliver it to Asia and other parts of the world. That doesn't work with natural gas. Natural gas ships are much more complicated. You're going to think much more carefully about sailing them through a dangerous place. And the transshipment, the transfer of cargoes, doesn't work in the same way. So oil and gas right now are in a very different situation.
OK. It's interesting to visualise those ships. And then we've also got this report today that Venezuela's considering quitting OPEC and that the US is in talks to take a stake in Venezuela's oil fields. In the big picture of oil markets, how significant is that?
It's not a huge... Venezuela leaving OPEC would not be as significant as when the UAE left OPEC earlier this year, because Venezuela isn't anywhere close to producing its OPEC quota and won't be for some time, so it doesn't actually have a direct impact on how OPEC manages supply and demand in the market. However, I think it is another big psychological blow to OPEC if it happens. Venezuela was a founding member. It was in the past an extremely influential and important member of OPEC, and it feels like OPEC is being chipped away at. We had Qatar leave, then the UAE, possibly Venezuela. Angola has also left, and it increasingly feels that it risks becoming a rump that is based around Saudi Arabia and a few other countries. OK,
so that organisation potentially crumbling. Will, thank you very much. That's Bloomberg's Will Kennedy. Now, the US Trade Representative Jameson Greer says that Washington should consider banning some Canadian goods as their trade war heats up. The clash is set to escalate, with President Trump signing an order renaming Lake Ontario as Lake America, saying that the move takes effect immediately. Now, let us turn back to tech, and we are looking at Nvidia down more than 1% this morning in the pre-market, down 1.2%. This, of course, after it added around $442 billion in market value yesterday, which was the second biggest one-day gain by any stock in history. Now, Nvidia's second quarter earnings and 70% revenue growth outlook for the next fiscal year triggered that largest single-day rally for the chip maker since April 2025. So let's get more now with Bloomberg senior strategist Neil Campling. Neil, this is kind of astounding because Nvidia's slipped post-earnings for the past 4 quarters, and yet yesterday it gained. You've told me that that's because it guided all investors all the way to 2028. Does that now mean that big tech names have got to give a longer-term view as standard, on top of beats and raises, just to impress this market?
Yeah, it's a really interesting point, Lizzie, because in many respects, investors do need the comfort. And part of the reason they need that comfort is, of course, because we're seeing significant amounts of cash flow degradation, CapEx spending going significantly higher. So if you get more visibility in terms of longer term guidance, it's certainly going to help that. I've seen some research that estimates that over $500 billion of depreciation expense by hyperscalers, for example, by 2030, which is as much as the entire operating profits of all 5 hyperscalers in 2026. So the more details they can give about the path of growth, the path of the revenue projection, it's going to help sentiment for sure. And then to Nvidia, the other aspect I've seen since we discussed it was that Citigroup said that amongst the big tech stocks, that actually into the print, Nvidia was no longer a crowded long position. And that also might explain why the stock moved so much yesterday as well.
OK, really interesting. And then I also just want to talk about Anthropic, because it's won its court challenge against a ban by the Trump administration. Does that set a precedent for how short a leash Washington can keep on these big tech firms?
Yeah, so it's interesting in that the California case that you referred to is one of 2 legal challenges brought by Anthropic, being labelled as a threat. But this is certainly, I think, a very important win for Anthropic, because we need to have these big frontier models being able to develop their technologies very quickly. And in fact, the judge did kind of suggest that this was a public showing by the Trump administration rather than being based on fact. So it's definitely important for Anthropic. And of course, Bloomberg had headlines yesterday saying that Anthropic's very likely to go for IPO at the end of next month. I think you had to clear this first, so it is a positive for that too.
All right, Neil, thank you very much. That's Bloomberg senior strategist Neil Campling. And we're going to stay with tech next. We'll be discussing the future of computing with the CEO of Nasdaq-listed quantum company Quantinuum. That conversation coming up next. This is Bloomberg. Good morning and welcome to The Pulse. I'm Lizzie Burden in London and these are your top stories. Waiting for Warsh. Traders avoid big bets ahead of the Fed chairman's first Jackson Hole speech, with the Fed divided on the rate outlook. Meanwhile, oil flows tick up through the Strait of Hormuz as the top US commander for the Middle East says that American forces have cleared Iranian mines from the key waterway. Plus, France's debt difficulties dominate the first presidential debate, as data out today shows the country's economy only narrowly avoided recession in the first half. Well, Fed officials continue to send mixed signals on their outlooks for inflation. Kansas City Fed President Jeff Schmidt says that the central bank's rate setting is not restraining the US economy as things stand.
The last Q3, Q4 data for me last year was I thought we certainly weren't restrictive and maybe even a little accommodative. So we've got work to do.
Let's get more now with Adam Linton from Bloomberg's MLive team. Adam, the market's holding its breath in advance of Kevin Warsh's speech at Jackson Hole today. I feel like we've really hyped it up. Is it just going to be a nothing burger if he says barely anything on how the Fed will fight inflation? Or is it really going to disappoint the market if he doesn't indulge us?
Yeah, I mean, this is very much the debate we're having on the Markets Live team at the moment. I mean, I kind of lean towards I think it will be relevant. Obviously, given the subject matter of this symposium, he could completely sidestep monetary policy. He could talk about payments, in which case we all get on with our lives. We look out for payrolls next week, CPI ahead of the September decision, and we'll probably see some residual hawkish pricing there, just because we don't know a lot about the reaction function of the Fed at the moment. I think if he does speak at monetary policy, then what he says really does matter. If we see a bit of a rerun, the July press conference where he was vague, he was evasive, markets were left scratching their head about what the plan is to get inflation back to target, and that would undermine the dollar and steepen the US curve. However, he does have an opportunity to give a little bit more flesh on the bones. I don't think markets are wanting their hands held, said we're going to hike this at this meeting or whatever. They just want a bit more of an understanding of the framework. And Warsh, according to FT reporting, has acknowledged he hasn't reinforced that message on inflation. Today is an opportunity to do so. If he does, he can support the dollar and flatten the US yield curve. OK, so it's kind of an asymmetric risk going into this. Yeah. We also had lots of European data out this morning. Top lines, Spanish inflation past 4%, French inflation accelerating to the highest level since May, just dodging a recession. Does any of that change your outlook for Europe? Yeah, I mean, I think in terms of the immediacy for the September ECB rate decision, that's a lock. They're going to hike 25 basis points.
But we knew that.
Yeah, exactly. I think what's more interesting is kind of the currents you're seeing building in the macro environment and what that means for European assets more broadly. I think if you look at European equities, for example, we're in a little bit of a holding pattern now. We've kind of lost this pillar of support from Q2 earnings, and we're kind of seeing some of the macro forces build. We've got higher gas prices, got the diesel supply crunch, got rising ag prices, got low water levels in the Rhine, got political risk in France, Germany, UK. It's all stacking up. And yes, Europe's story has been one of resilience in 2026, but that can't just go on indefinitely. And I think, if you look at equities, the problem is that, we've seen earnings revisions rise higher and higher and higher. It raises a relatively high bar for Europe. And if you get any signs of fragility, we could be set for disappointment. And then for the European curves, front end's probably a little bit more anchored. We've got a couple of hikes baked in, but further along the curve, if inflation persistence becomes more dominant, at a time when these fiscal fragilities are on show, we could have high yields still.
OK, Adam, thank you very much. That's Bloomberg's Adam Linton on that latest European data and setting us up for Kevin Warsh's speech at Jackson Hole. Now, the US, China and other countries are lining up financing in the race for superiority when it comes to quantum computing. The technology had been hailed by analysts as the next market-defining computing revolution after artificial intelligence. Quantum computing harnesses quantum physics to tackle certain complex problems far faster than conventional computers, but investor enthusiasm has cooled since the start of the year. Let's get the inside view now. We can speak to Rajeeb Hazra, CEO of quantum computing company Quantinuum. You're just in town for a couple of weeks, I think, so welcome to Bloomberg TV. I want to start with the big picture then. Do the improvements in AI make quantum less relevant?
Actually, thanks for having me. It's wonderful to be here. Secondly, we actually see the growth and improvement in AI as a very helpful factor. Because what we do is we don't see AI competing with quantum. We see AI solving certain kinds of problems very well, and quantum then being used to make the I in AI, the intelligence in AI, more enhanced. So, for instance, when AI is starting to now take over the job of creating new kinds of molecules for energy, for new battery sources, drugs, that automation needs to be intelligent. It needs to have a way to understand how chemistry works. That's what quantum computing does. So for us, it's very much AI and quantum. And for that, we need not only the quantum to improve, but we need AI to improve as well.
But does quantum need AI more than AI needs quantum?
I think when we work with customers and look at whether it's a pharma customer, it's a chemical customer, it's a materials or an optimization bank, they don't ask which one is more important. They say it's important to solve this problem. And in that workflow, there are certain things on classical does well, and certain things that absolutely cannot do, either efficiently or at all. And that's where you put the two together. It's kind of like saying, if you have a part that you didn't have, the big structure would fall. Well, how important is that part? It's critical.
OK, it makes sense. I also want to talk about the US administration investing in the sector. It's been quite recent, that, actually. But what does it tell us about how critical quantum computing is to national security and to tech sovereignty as well?
Absolutely. It's a clear indication that, in today's knowledge economy, to compete, you have to compute.
Yeah.
Right? Everything is in a digital economy. So the executive orders from the White House, as well as some of the follow-on activity, has been actually eye-opening in terms of bringing the now of quantum into focus. For a few years, people have wondered, is quantum 5 years away, 10 years away, 15 years away? The investment, the directives to actually go implement quantum over the next couple of years is a very clear sign that, A, it's a critical part of your industrial and national security fabric, and it's imminent.
But did it come with restrictions? Did the government, have conditions about the supply chain for the funding? Because we've just seen Anthropic win its case, right, when it came to the court challenge. But is quantum going to have an Anthropic moment, do you worry?
No, I mean, what we see is every nation, U.S. included, is strengthening its position in quantum. That means companies' creation of IP and onshore supply chains. And that is what the recent U.S. government moves have been, is to ensure that the U.S. companies have access to an onshore, rich, diverse supply chain to be able to compete for a market that is worldwide.
Well, the White House put $1 billion behind IBM to build a foundry in New York. Is it putting its money in the right places?
Well, what it's betting on is, from our perspective, yes, because what it's betting on is the places where, or the modalities, as it's called, that are most promising in terms of delivering this commercial value unlock. And if you noticed, they chose multiple companies, both in the quantum space and then multiple companies that serve as the supply chain into those companies. We were the only trapped ion company picked. But in addition to IBM, there's also Global Foundries. That is a foundry supplier to many of us that aren't in the superconducting IBM mode.
OK. You also, while you're in town, you're looking at where to invest more in the UK. You were talking about Oxford, Cambridge, London. We know that the UK plans to spend £2 billion on quantum, but that was something that came under the Starmer administration. Have you any updates on that while you've been on this trip?
No, I don't have an update, but we believe that the focus on improving and accelerating quantum, both technology creation and adoption, is a national strategic imperative, right? Our history is we've been based, partially out of London, Cambridge, and Oxford ever since we were born. We are the kind of culmination of two companies coming together. So we have a rich history, we have a rich network, and we have a rich hope for the future of what we would do here.
But has there been any change in the tone or amount of engagement under the Burnham administration?
Not really.
Okay.
I mean, we continue to see good focus on workforce development, on technology creation, on testbed and access. And I think that is all very positive and aligned with the long-term direction of a technology that promises to be the next frontier of compute.
I've just been looking at your stock. You still, I have to say, below the IPO price. So you're down about 10% from the $60 that you listed at in June. You did have this amazing day after earnings, 28% single-day surge. What's your message to investors who bought at the IPO price and are still underwater?
Yeah, so it's very simple. Quantum is a transformational technology, and you need to bet on those. The company that is going to create the best hardware, the best developer platform, and then actually work to create the applications that create the value, right? We are that company. We have a technological lead in what's called fault-tolerant quantum computing. We have a widely deployed developer platform that is compatible with Nvidia and AI infrastructures. And we have leading infrastructure providers and partners like Oracle, as we announced, working with us to accelerate adoption. This is a huge market. But, you know, you can go and look at numbers, but it's in trillions by the end of 2030s. But even in the next 3 to 4 years, it's in the tens of billions of user value created. So this is about who gets and unlocks that value first and in the largest sort of way.
Well, yeah, because you're a graduate of Intel and Micron, companies that know how to manufacture at scale. How far away is Quantum from that kind of maturity when it comes to manufacturing?
We are maturing it, right? So if you look at our the agreement we have with Quanta, if you look at even the U.S. government LOI, our focus is not just building one machine that does something amazing. Our focus is on being able to supply to the demand that we see coming for companies that want to buy it on premise, for use it in the cloud. And so we have paid particular attention to getting a supply chain and manufacturing strategy implemented at scale.
And just before I let you go, Raj, what are you most excited about coming? Because I know you've got Sol slated to launch next year. What's the biggest risk between the now and the launch for that? And what can you tell us
so
about what's in the
we feel very good about Sol, because part of our strategy has been is every generation of system, which is Helios in the market today, de-risks the next generation. So as I said in the earnings call, we have the early parts of Sol back. We're assembling it. We've already de-risked some of the critical technologies Sol will need. So we feel very comfortable about Sol. But Sol represents a gigantic step forward in then further de-risking what fault-tolerant quantum computing can be. You know, 2 years ago, about a year ago, people were still talking about error correction as something of a dark science and an art. We've demonstrated it. We've got 5 nines fidelity, which is like 99.999% accurate. Wow. And that's what's critical for opening up applications in pharma, in energy, and optimization. So that is what we do. What we're most excited, you asked me what I'm most excited about, is that level of capability that 2 years ago people thought was 10 years away.
Okay. Really great to have you on, Raj. Rajeeb Hazra, CEO of Quantinuum. Thank you so much for stopping by. Well, Bloomberg Intelligence is today noting how Meta's US settlement over harm to children is unlikely to slow Europe's push for social media age limits. The US deal doesn't require a European rollout of safety features, so potential bans remain a much larger long-term threat to growth. Tamlin Basin is technology analyst here at Bloomberg Intelligence. He joins me now. Welcome. So what does Meta's US settlement actually change for teens, and does it affect users in Europe?
Right. So the settlement that was announced, really, this was a lawsuit that was brought by 29 attorney generals of states in the U.S. And during the trial, Meta agreed to settle. The settlement is for a total of up to $18 billion. And in addition to those fines, there are behavioral remedies. And this is going to limit teen usage of up to two hours a day on Meta's platforms. It's also going to change things like the algorithm, their feed. And also, there's going to be more parental controls. There's also a curfew from midnight to 7 a.m.
I could do with that.
I think many parents are looking at this and saying, oh, this does seem in the best interest of our children, who we've noticed are using a lot of screen time. It does not automatically apply to Europe. This was a U.S.-brought lawsuit. This, by the terms of the agreement, is only going to apply to U.S. So there's no necessarily legal mandate to make it apply to Europe. Whether Meta chooses to roll it out or not is a different question.
Exactly. Do you think it makes it more likely that European governments will ban social media for younger people?
So it's really interesting because if you look at what's motivating a lot of this European momentum for these outright bans, it's really not just limiting usage, but limiting access. A lot of the arguments is that social media is harmful, especially for the younger cohort, so 13, 14, 15. So I don't think a lot of those regulators are going to really see these things limiting usage as really appealing to them. Mm-hmm. I think as of the terms of the agreement now, that they're probably going to move forward with outright bans that we're seeing being pushed ahead in Europe.
OK, and why would a European teen ban matter so much for Meta, TikTok and Snap?
And I think that's the key question. And if you're limiting usage, teens are still on there. They're still forming their cliques. They're still forming your groups. So it's really pretty critical to the lifetime value of that app to the teen. And for engagement, for advertising sales, they're still in the pipeline. An outright ban really knocks that down. It knocks that down. In fact, by the time they're able to join 16, 17, there might be other things that they're interested in. So it's really more important for the platforms. Yes, they might be able to limit, the usage might be limiting, but having them on the platform is really key. So I think for them, avoiding the ban would be really the best interest for the platforms.
I don't know about that. I know some octogenarians who are hooked on Facebook. They started late in life. Tamlin, thank you very much. That's Tamlin Mason, technology analyst at Bloomberg Intelligence. Well, coming up on the Pulse, it's 2 months until the first budget for the new UK government, and we're going to discuss how Britain can remain attractive for investors. That's next. This is Bloomberg. Well, there are now 2 months until the new UK Chancellor outlines his first budget statement. Ahead of the two previous annual speeches, the UK economy took a knock from widespread fears of tax hikes to pay for the ruling Labour Party's spending priorities. Let's discuss the outlook now for investors with Rajaa Mekouar, who is Special Advisor to the CEO at family-backed investment firm Capnor. Really great to have you in person this time. Last time we spoke, you were talking about how UK political uncertainty was kind of weighing on the attraction of London's legacy reputation. Are you encouraged by the change of government from Starmer to Burnham?
No, I think, Lizzie, and nice to see you in person, too early to say. I would say that right now investors, not only in the UK but also in the US and other parts of the world, are trying to keep their convictions and strategies alive despite political uncertainty, despite geopolitical turmoil. And I think everything that is going to the way of optimism is fueled by the AI and quantum computing revolution. I think this is an unprecedented reset of everything we've known and done, even as a civilization. And I think a lot of private capital is looking that way and profiting from all kinds of opportunities that arise from that.
And indeed, we were just having a conversation about how exciting the opportunities are when it comes to quantum. But, of course, if that's lifting all boats and you're trying to decide, as someone wealthy, where to put your money, what would the Chancellor have to do in the October budget to attract that capital to the UK? Because I know the Prime Minister has talked about the UK having overtaxed labour and undertaxed wealth. Is that not the kind of signal that makes your clients nervous?
Well, we don't have clients because Capnor is a single family office, but let's say investors have a global outlook. London remains a base from which to do investments. not necessarily in the UK, sadly, but we have an office here where London is still the backyard for US money to come and scout around Europe. London has a pool of talent that is still not matched from a critical size perspective in any other city in Europe. And London still has amazing infrastructure, education, all kinds of attractions that go beyond, political issues. Having said that, a wealth tax is always a word that is very much hated. It doesn't mean that, the wealth that I'm used to has to be living here, but the wealth can be managed out of here. And there's many different ways to look at it. And I don't think it will erase London from the map. But no wealth tax would be great. And let's see what the budget's going to bring to us.
Well, yeah, do you think that Healey gets that? Because he's just been out on the airwaves again this morning, emphasising this message that he understands the importance of fiscal credibility. That's all well and good for the bond vigilantes, but what about wealth? Is he getting through to wealth?
But also UK wealth, not even international money we're talking about, and I have a lot of UK investor friends who are very worried about that. So let's send him some signals, but I'm sure there's all kinds of lobbying exercises being done out there.
Has the exodus of non-doms from the UK under Labour been exaggerated? I know that you've moved back to the UK.
Yes,
Are you the proof that it's been exaggerated?
Well, I think there's one feature of what the government did after the end of the traditional non-dom that is very underrated. It's called the FIG regime, which is what I'm under now. Gives you a 4-year window to be here, very free, and you're not taxed on any non-UK income. This regime is also positive because you have the remittance basis on any amount of capital. So you have to have been out for at least 10 years or to have never been here. So for international talent, I think it's very interesting. I'm very pleased. But I didn't move back because of FIG. I think it's very hard to find an alternative to London when you're an active investor with an international outlook. I also want to say the government has done some good things, and actually to your previous guest, there's a big government funding package around quantum, and few people know that broadly, but yesterday I was just speaking to a quantum company. The best photonics university in the world is actually in the UK, in Southampton. There's fantastic talent coming out of there. There's still not enough talent. The government is backing this in a big way, so let's keep doing more of this. The CEO of that particular company told me, please don't change anything in that way. So there are some silver linings here and there that we should focus on as well.
OK, really interesting to get that perspective as well. And just on AI, you've written that AI could be one of the great equalisers for family offices, institutional quality information processing without institutional scale headcount. Are you already seeing that? Are you seeing jobs going?
Well, I think jobs are changing, but at Capnor nobody was let go of because of the AI revolution, but the processes have been streamlined. The due diligence processes have been increased in terms of efficiency and speed, so that's fantastic. I mean, we have to see it also in the back office functions, so we'll see how that affects jobs. But anyway, in the family office, typically you don't have a big payroll, but for sure, I think in any support industry, there'll be a lot of changes, but I would say it's about upskilling, retraining, and that's why I was saying, for instance, any computer science degree now has to integrate the new AI revolution dimension, and there's fantastic prospects. I mean, you have to be optimistic of what's going on right now and take into account the fact that this has never happened ever before. One watch-out point, which I know a lot of practitioners have been raising, is around governance of AI, intellectual property, and the fact that, we need to control this intelligence that is not human.
But then, you talk about how Europe doesn't have an innovation problem, it's a scaling problem.
Absolutely.
We've just seen this week 2 European companies choosing to list in the US rather than at home. Agreco out of Glasgow and Aura from Finland. What's the answer to that?
Yeah, I think it's a very important point, and worrying point in a way that the talent, the ideas, the innovation are in Europe, but then the scaling for commercial traction is in the US. And I've been now 3 times to the US this year, spent extensive time on the ground, and it's just that the US markets reward growth. European markets still want to see the bottom line right away. And with this, the lead time between the moment you innovate, the moment you see the actual reward in your bottom line, there's a big gap. And this is where I think Europe is falling behind. They're not enough rewarding growth and too focused on the downside instead of the upside. And that's something I really pity and regret, and I hope this will change over time. And that's why you have no choice but to list on the NASDAQ. I have other companies that I've been following and involved with for a long time, and they all regret having listed in Europe, and they all now want to move to the US. And it's really the scale, the depth of the market, and this mindset of rewarding growth.
What a depressing thought to end the show on. Rajaa, thank you for coming to see us. That's Rajaa Mekouar, Special Advisor to the CEO over at Capnor. Really great to see you. Thank you so much. Well, stay tuned to Bloomberg for full coverage from Jackson Hole today, as well as that keynote speech from Kevin Warsh. Other central bankers are available. We'll be bringing you interviews with the Cleveland Fed President Beth Hammock, Bank of England MPC member Catherine Mann, and the Governor of the BOE, Andrew Mann, and also ECB policymaker Martin Cocker. So a full slate of conversations for you. And just checking in on these markets, Nasdaq futures are down 0.3%. The Stock 600, though, is up 0.5%. Happy Friday, everybody. Have a great weekend. Bloomberg Brief is next. This is Bloomberg.